to address you on the topic of old tax regime versus new tax regime and changes made by the Finance Act 2023 pertaining to TDS and TCS. Before starting, I want to introduce my editorial team and technical team to you. Editorial team is headed by Naveen, and the other members of the team are Rahul, Dipen, Tarun, Ashish, Radhima, and Manila. Technical team is headed by Sumita. Other members are Abhishek, Amit, Hemchand, Jatin, Kamal, Priyanka, Sakshi, Subham, and Naresh. Before starting, I want to request you to please type your questions in the chat box. Whenever you have any query, my editorial team will answer the query immediately within 2-3 minutes. And at the end of the session, a few common questions which you have raised, I'll be answering in the live mode. 60 minutes are available with me. Around 45-48 minutes, I will discuss the subject with my presentation. And last 10 to 12 minutes, I will utilize in answering your questions. My editorial team will prepare common questions, and those questions briefly I will be answering. And now I'm going to start the session. Alternative tax regime and changes pertaining to TDS, TCS made by the Finance Act 2023. First, I'm starting with the alternative tax regime under section 115BAC. In this segment, I'll be covering section 115BAC pertaining to these points. Number one, who is covered under the alternative tax regime? I'll be referring in my discussion the term alternative tax regime and regular tax regime frequently. Alternative tax regime, that is covered by section 115BAC, the new tax regime, the default tax regime. Regular tax regime, which is not covered by 115BAC, which is covered by the normal provisions. Secondly, I will discuss tax rates under the new regime. What is the exemption limit? What is the scene of rebate under section 87A? What are the tax rates for special incomes like long-term capital gain, lottery income, short-term capital gain, etc.? How much is surcharge and education cess in the new regime? And the most important thing, what are those incentives which are blocked under the new regime? Is there any incentive which is not blocked, which is available even under the alternative tax regime? Whether alternate minimum tax is applicable? And how to exercise the option? Whether the option is available while deducting tax at source under Section 192? One by one, these subjects I will be covering. And before starting the next topic, I will also discuss, with the help of a small case study, when it is beneficial to opt for the alternative tax regime. Who is covered by the alternative tax regime 115BAC? Any individual? Any Hindu undivided family? Any AOP, BOI, or artificial juridical person? These taxpayers, at their option, can join alternative tax regime. But from the assessment year 24-25, the alternative tax regime is going to be the default tax regime. Individual may be resident, may be non-resident. Likewise, HUF may be resident or non-resident. Second is, what are the tax rates? These are the tax rates under the new regime, applicable from the assessment year 24-25. Up to rupees 3 lakh, there is no tax. Between 3 lakh and 6 lakh, tax rate is 5%. Between 6 lakh and 9 lakh, tax rate is 10%. Between 9 lakh and 12 lakh, tax rate is 15%. Between 12 lakh and 15 lakh, tax rate is 20%. And above 15 lakh, tax rate is 30%. These are the tax rates for the assessment year 24-25 under Section 115BAC, subsection 1A. These tax rates, as I said, are applicable under the new regime. New regime is going to be the default tax regime. Under the old regime, that is the regular tax regime, let us have a look. Up to 5 lakh, tax rate is 50%, tax rate is 5%. Between 5 to 10 lakh, tax rate is 20%. And above 10 lakh, tax rate is 30%. Exemption limit. Under the new regime, exemption limit is rupees 3 lakh. This exemption limit of 3 lakh is applicable for every person, whether he is a senior citizen, non-senior citizen, or super senior citizen. Under the old regime, the regular tax regime, exemption limit is 2,50,000 ordinarily. But in the case of senior citizen, exemption limit is 3 lakh. And in the case of super senior citizen, exemption limit is 5 lakh. The three system of exemption limit is applicable only under the old regime, regular tax regime, not under the alternative tax regime. Rebate under Section 87A. For the assessment year 24-25, under the alternative tax regime, will be applicable in the case of a resident individual having total income of not exceeding rupees 7 lakh. If these two conditions are satisfied, then 87A rebate for the assessment year 24-25 under the new regime will be 100% of income tax or rupees 25,000, whichever is lower. There is a marginal relief also, which has been introduced in Section 87A for the first time, applicable from the assessment year 24-25. If income of a resident individual is above rupees 7 lakh, but not more than 7,27,770, then it is subject to marginal relief. What is the old version of Section 87A? For the regular regime, old version is still applicable. For the new regime, the old version is applicable till the assessment year 23-24. Under the old version, the total income should not be more than rupees 5 lakh. Only then 87A rebate is available. Another change under the old regime is that the amount of rebate is 100% of income tax or rupees 12,500, whichever is lower. And under the old regime, there is no marginal relief. I'm repeating, the old version of 87A is applicable till the assessment year 23-24. In the case of alternative tax regime, the old version is applicable in the case of regular tax regime, even after the assessment year 23-24. For the regular tax regime, there is no change under Section 87A. For the alternative tax regime, the limit of 7 lakh in the income and the rebate 25,000, both are applicable, but only in the new regime. How this marginal relief is applicable? I can take a small example to illustrate how this marginal relief is applicable. Suppose income of a resident individual is rupees 7 lakh. He is in the new regime, alternative tax regime. Income tax on 7 lakh rupees comes to rupees 25,000. Because he is a resident individual, because his taxable income does not exceed rupees 7 lakh, he is qualified for 87A rebate. That is 100% of income tax or rupees 25,000, whichever is lower. He is qualified for the rebate of rupees 25,000, and after rebate, his tax liability is 0. Suppose this individual gets an additional income of rupees 10,000. Income becomes 7,10,000. On 7,10,000, tax liability is 26,000, and there is no rebate. Why there is no rebate? Because income exceeds rupees 7 lakh. What this person should do? Any normal person will advise him, you surrender the income of rupees 10,000 before its accrual. Forgo the income of rupees 10,000. If he surrenders rupees 10,000, the additional income, his normal income would be rupees 7 lakh. Rebate would be available to the full extent, and tax liability will be 0. Even after surrendering rupees 10,000, he is saving the income tax of rupees 16,000. If he does not surrender, tax liability is 26,000. If he surrenders 10,000, he will be saving the tax of rupees 26,000, and the net saving after excluding the surrender becomes 16,000. 16,000 would be the tax saving, and exactly the same thing is the rebate. 16,000 is tax saving under the marginal relief. In this case, 16,000 would be the tax rebate under Section 87A. The amount which I am foregoing will be the income tax liability. 10,000 would be the income tax liability on the income of rupees 7,10,000. There is another way of calculating it. The difference between 7 lakh and the taxable income is the amount of income tax after tax rebate, but there is no marginal relief in the case of health and education cess. He will have to bear 400 rupees extra, and the final tax liability would be 10,400. This marginal relief was not there under the earlier version, but from the assessment year 24-25, under the alternative tax regime, he would be qualified for the marginal relief. And in this example, it comes to rupees 16,000, that is the amount of tax rebate. The next point is how special incomes are chargeable to tax. Special incomes, lottery income, long-term capital gain, short-term capital gain. These special rates are covered by Chapter 12 of the Income Tax Act. And these special rates will continue even under the alternative tax regime. In other words, if there is a lottery income, it will be taxable at the rate of 30%. If there is a short-term capital gain, 111A, 15%. If there is a long-term capital gain, depending upon the section 112 or 112A, 10% or 20% would be the tax rate. These rates will continue even under the alternative tax regime. Surcharge and education cess. We all know that in the case of individuals HUF, there are 4 different rates of surcharge. 10% is applicable if income is above rupees 50 lakh. 15% is applicable if income is above rupees 1 crore. 25% is applicable if income is above rupees 2 crore. And 37% is applicable if income is above rupees 5 crore. Besides, there is an education cess to the extent of 4%. Under the alternative tax regime, from the assessment year 24-25, the rate of 37% will not be applicable. Meaning thereby that if income of an individual opting for the alternative tax regime exceeds rupees 2 lakh or exceeds rupees 5 lakh, the surcharge will remain the same, 25%. Even if the income is above rupees 5 crore, the surcharge of 25% would be applicable. And now the most important things, tax incentives which have been blocked, which are not available. Tax rates are lower, but at the same time, a few tax incentives, important tax incentives, have been blocked, not available under the alternative tax regime. One by one, I'm preparing the list of blocked incentives, and I'm repeating these blocked incentives are available under the regular tax regime, but under the alternative tax regimes, these are not available. Leave travel concession, LTC. No exemption pertaining to LTC under section 10, subsection 5, under the alternative tax regime. House rent allowance. House rent allowance exemption. House rent allowance exemption under section 10(13)(a) will not be available. Special allowances under section 10, subsection 14 will not be available. Conveyance allowance, traveling allowance, education allowance, these allowances are not applicable, except a few ones. Allowances pertaining to MPs, MLAs under section 10(17), no exemption would be available. A small exemption is there under section 10, subsection 32, when income of a minor child is clubbed with the income of his father or mother. This exemption of rupees 1,500 under section 10, subsection 32 will not be available under the alternative tax regime. A special economic zone tax holiday under section 10, subsection 10, under section 10AA will not be available. A standard deduction in the case of a salaried employee, this was not available till the assessment year 23-24 under the alternative tax regime, but from the assessment year 24-25, one will be able to claim a standard deduction even under the alternative tax regime. I'm taking it out of the blocked incentives list. The standard deduction is not there from the assessment year 23-24 in the list of blocked incentives. Entertainment allowance deduction in the case of government employees, central government employees, state government employees, which is normally available to the extent of rupees 5,000 if a few conditions are satisfied, will not be available under the alternative tax regime. Professional tax deduction under Section 16, Clause 3I is not available under the alternative tax regime. Interest on borrowed capital in the case of one self-occupied property or two self-occupied properties under Section 24, subsection B will not be available. I can illustrate this point with the help of a small example. Suppose a person has got two properties. One is self-occupied, the other is let out property. How income is calculated under the regular tax regime pertaining to self-occupied property? Annual value is taken as 0, no municipal tax deduction is available. Net annual value after municipal tax is again 0. Standard deduction under Section 24A is not available in the case of self-occupied property. And suppose there is interest liability, which is rupees 2 lakh or more than rupees 2 lakh. Under the regular tax regime, a deduction of 2 lakh rupees is available. Consequently, income from self-occupied property under the regular regime is minus rupees 2 lakh. Second property, let out property. This is the annual value, 6,25,000 minus municipal tax 25,000. Net annual value is rupees 6 lakh. Standard deduction 30% under Section 24, subsection A, 1,80,000. And entire interest liability is deductible. Suppose it is 2,80,000, and consequently let out property income is 1,40,000. Now he has got two properties, one self-occupied, the other one is let out property. Self-occupied property minus 2 lakh, let out property rupees 2,40,000. Under the regular tax regime, I can set up this 2 lakh against other incomes of the within the head of house property. And if still it is not available, I can set it up against salary income, business income, any other income. It means 2 lakh deduction would be available first from house property income, then from other incomes, and net effect would be from the gross total income, 2 lakh would be deducted. This is under the regular tax regime. What is this in under the alternative tax regime? Under the alternative tax regime, even this 2 lakh is not deductible. Income from house property would be nil pertaining to self-occupied property. Income from house property pertaining to let out property will remain same, 1,40,000. And the overall income from house property would be 1,40,000. What I want to say is that if there is interest liability pertaining to one self-occupied property, two self-occupied property, which is normally available as deduction under Section 24, subsection B, to the extent of rupees 2 lakh, is not available under the alternative tax regime. There is another point that if there is a loss under the head income from house property, it cannot be adjusted against any other income, against any non-property income. One small example. Suppose a person has two properties, one is self-occupied. Suppose a person has two properties, both are let out properties. Calculated income is available pertaining to property 1, 17 lakh rupees, pertaining to property number 2, minus 25 lakh rupees. Overall income under their income from house property is 8 lakh rupees. Other income is 35,000 rupees. Under the regular tax regime, out of 8 lakh, 2 lakh I can set off during the current year, and 6 lakh will be carried forward. It means current year income under the regular tax regime would be rupees 33 lakh. Under the alternative tax regime, 17 lakh would be the income from property 1. Minus 25 lakh will be the income from property number 2. Income from house property would be taken as 0, not minus 8 lakh. Other income would be 35,000, and net income would be other income would be 35 lakh, net income would be 35 lakh. This loss, this 8 lakh loss cannot be adjusted. Normally, I can adjust 2 lakh during the current year and 6 lakh during next 8 years. And this will be dead loss. Minus 8 lakh will become 0 in the case of alternative tax regime. This rule Thus, minus 8 lakh cannot be adjusted against other income is applicable only when the overall income under their income from house property is negative. Within the head of income from house property, I can adjust any loss from let out property. Take this example. This is the case when two properties are there. Let out property result is giving income of 47 lakh rupees. Let out property number 2 is giving income of minus 25 lakh rupees. I can adjust the entire amount within the head of house property, and resulting house property income is a positive income 22 lakh. If the resulting house property income is the positive income, then this rule of blocked incentives is not applicable even under the alternative tax regime. Under the alternative tax regime, my house property income would be 22 lakh, other income would be 35 lakh, and overall income would be 57 lakh. What I want to say is that this point becomes activated only when the overall income under their income from house property is negative. Within the head house property, you can adjust any loss. Additional depreciation is not available under the alternative tax regime. Investment allowance, in the case of backward area, 30 to 80 deduction is not available. Tax incentives under section 33AB, 33ABA will not be available. Deductions pertaining to scientific research under section 35, subsection 1, clause II, clause III, 35 2AA will not be available. If it is possible, you can claim under section 37, but otherwise it is not available. Capital expenditure under section 35 AD, which is normally available to the extent of 100% as deduction, will not be available. Similarly, no deduction under section 35 CCC would be available under the alternative tax regime. Standard deduction in the case of family pension, 15,000 rupees or 1/3 of family pension, whichever is lower, was not available under the alternative tax regime, but from the assessment year 24-25, it will be available. And no deduction under chapter 6A, barring a few sections, 80CCD subsection 2, 80JJAA, and 80LA 1A. Barring these 3, 4, no other deduction under chapter 6A would be available. That is starting from section 80C, ending with 80U will be available. This is the list of blocked incentives. Now the next point is, what are the incentives which are available? Even under the alternative tax regime, a few incentives have not been blocked. Now I'm preparing the list of those incentives which will be available even if a person is paying tax under the new regime, that is the alternative tax regime. Interest on public provident fund. Exemption is available even if a person is opting for the alternative tax regime. Final payment of PPF, there is no tax liability. This incentive will continue. Interest on Sukanya Samriddhi account and final payment from this account, both will be exempt, even under the alternative tax regime. And similarly, the exemption pertaining to retirement benefits, like gratuity, commutation of pension, leave encashment, retrenchment compensation, BRS compensation, tax on non-monetary perquisite, these will be available. And similarly, the exemption under section 10, subsection 10CC, that is on non-monetary perquisites taxes paid by the employer, this will continue even under the alternative tax regime. Exemption pertaining to life insurance policies under section 10, subsection 10D will continue even under the alternative tax regime. Provident fund interest, which is exempt under section 10, subsection 12, will be available. And withdrawal from NPS and provident funds, the incentive which is available to the regular taxpayer will also be available to the alternative tax regime taxpayers. Similarly, the exemption under Section 10, subsection 13 pertaining to payment from approved superannuation fund, this will continue even under the alternative tax regime. Alternate minimum tax under Section 115JC, under Section 115JC will not be applicable to those taxpayers who are paying tax under the alternative tax regime. How to exercise the option is the next point. Alternative tax regime is the default tax regime from the assessment year 24-25. If you are not taking any action, if the taxpayer is not taking any action, he will be transferred to the alternative tax regime automatically by default. But if a person wants to continue in the regular tax regime, he will have to submit an option. If you want to remain in regular tax regime, you have to exercise the option pertaining to the assessment year 24-25 or subsequent assessment year. In the case of salaried employee, this option has to be exercised every year. One can change it if one wants. But in the case of a businessman having income from business or profession, this is one-time option. Once it is exercised for the assessment year 24-25 or any of the subsequent year, then it will continue throughout the life of the taxpayer. One withdrawal is required, otherwise it will continue. In the case of a salaried employee, the option can be exercised in ITR 1 or ITR 2 itself. But in the case of a businessman, earlier the form was 10IE, and this year from 24-25, a new form will come or the same will continue after modification, nobody knows. I'm repeating. If no action is taken by the taxpayer for the assessment year 24-25, he or she will be transferred to the alternative tax regime. If option is exercised for regular tax regime, only then the provisions pertaining to regular tax regime will be applicable. In the case of a businessman, this is one-time option, subject to one change only. In the case of a person not having any business or professional income, this option to remain in regular tax regime will have to be exercised every year. The next point is, can I take the benefit of alternative tax regime for TDS purposes under Section 192? If no option is taken, if no choice is given, the employer will deduct tax under the alternative tax regime. But if the employee wants to go for the regular tax regime, he will have to give the option to the employer. Once the option is exercised in the same financial year, it cannot be withdrawn before as far as the TDS provisions are concerned. But at the time of final submission of the return of income, the employee will have to opt out again, and the same could be different to what is given to the employer under Section 192. Under Section 192, if no action is taken by the employee will be transferred to the alternative tax regime. Under Section 192, if the employee wants to remain in the regular tax regime, he will have to give the option to the employer. After giving the option to the employer will deduct tax under the regular tax regime. And to the employer, this option cannot be changed for the same financial year. At the time of final submission of return of income, he has a choice again to remain in alternative tax regime or the regular tax regime. And for this purpose, in the written form ITR 1, ITR 2, he can give the option whether he wants in alternative tax regime or regular tax regime. And it could be different from what is given to the employer under section 192. Now, the most important thing, when alternative tax regime is beneficial to me. For this purpose, you have to calculate the amount of blocked incentives. And you have to calculate the amount of income before giving blocked incentives. If the two figures are available, then a few broad conclusions can be drawn. If income before blocked incentives is more than rupees 5 crore, then generally alternative tax regime is beneficial because of surcharge of 37%, which is not applicable under the alternative tax regime. In this case, the regular tax regime would be beneficial only when the blocked incentives is quite abnormal, 50 lakh rupees, 60 lakh rupees. Only then all regular tax regime would be better in this category, having income of more than rupees 5 crore. Second category is income is above rupees 15 lakh, but not more than rupees 5 crore. If income is above rupees 15 lakh, but not more than rupees 5 crore, and the quantum of blocked incentives is more than rupees 3,75,000, then regular tax regime is better. I'm repeating, income is more than 15 lakh rupees, but not more than rupees 5 crore. And the quantum of blocked incentives is more than rupees 3,75,000, then regular tax regime is better. In such a case, alternatively, if the blocked incentive is lesser than 3,75,000, then alternative tax regime is better. This rule of 375 is applicable when income is in the range of 15 lakh to rupees 5 crore. Next is when income is more than 7,27,770, but not more than rupees 15 lakh. In this case, if the quantum of blocked incentives is more than rupees 3,75,000, no if or but, regular tax regime is better. If quantum of tax blocked incentive is lesser than 3,75,000, then in some cases alternative tax regime is better. In some cases, a regular tax regime is better. One has to make calculation under the two regimes separately to find out which one is beneficial. If income is above 7 lakh rupees, but not more than 2,27,770, that is the case of marginal relief in this under section 87A. In this case, if the quantum of blocked incentives is more than 1,51,000, more than 1,51,500, then regular tax regime is better. If it is lesser than 1,51,500, then alternative tax regime may or may not be better. If income is not more than rupees 7 lakh, if income is not more than rupees 7 lakh, then always alternative tax regime is better. A regular tax regime will give higher tax liability. In the case of senior citizen, this 3,75,000 would be 3,66,667. You can read 3,75,000 as 3,66,667. A few examples I can take. This is the case of a person having income of rupees 34 lakh. He is getting HRA exemption. HRA amount is 3,15,000. Exemption is also 3,15,000. This exemption is available under the alternative tax regime, but not available. This exemption is not available under the alternative tax regime. This exemption is available under the regular tax regime. He is getting standard deduction minus 50,000. Other incomes 21,000. ATC deduction 1,50,000, which is not available in the case of alternative tax regime. And interest on savings bank account 10,000, it is exempt under 80 TTA, which is not available under the alternative tax regime. This is our income under the regular tax regime. This is the income 36,86,000 under the alternative tax regime. Now, if I calculate the amount of blocked incentives, this is the case where income is more than 15 lakh, but not more than rupees 5 crore. And what is the quantum of blocked incentives? HRA exemption, the first blocked incentive, 3,15,000. ATC deduction, the second blocked incentive, 1,50,000. ATTTA deduction, the third blocked incentive in this case, 10,000. The total is 4,75,000. Our break-even point is 3,75,000. And because it is more than 3,75,000, which is blocked incentive, the regular tax regime would be beneficial in this case. Let us have a look. Under the regular tax regime, the tax liability is lesser as compared to the alternative tax regime. Slight modification in this example. Suppose the quantum of blocked incentive pertaining to HRA is not 3,15,000. Exemption is available to the extent of 1,16,000, and the remaining is the blocked incentive. Now, not full exemption is there. HRA exemption is partially exempt to the extent of 1,60,000. Other figures are the same. Let us recalculate. Our income before blocked incentive is the same, more than 15 lakh, but not more than rupees 5 crore. And what is the quantum of blocked incentive? 3,15,000. This is 1,60,000 is the exemption, which is not available in the case of HRA. 1,50,000 is the exemption, which is not deduction, which is not available under Section 80C. 10,000 is the deduction, which is not available under Section 80 TTA. Income is more than 15 lakh, but not more than rupees 5 crore. And the quantum of blocked incentive is lesser than 3,75,000. It is 3,20,000. And without making any calculation, I can declare that alternative tax regime is better. Let us have a look. The tax liability is lesser under the alternative tax regime as compared to the regular tax regime. This is the presentation pertaining to alternative tax regime. Now I'm coming to the other topics pertaining to this talk. TDS and TCS changes, and the first TDS and TCS changes is TCS changes pertaining to foreign remittance, Section 206C, subsection 1G. Let us see one by one what are the tax rates before amendment, after amendment. If there is a remittance for education, and this remittance is out of loan taken from a financial institute which is qualified for 80E deduction, then TCS rate is 0.5%. There is a threshold limit of rupees 7 lakh. If there is a remittance for education but not covered by Section 80E, then TCS rate is 5%, subject to a threshold of rupees 7 lakh. In no pen case, if 80E deduction is available, then TCS rate is 5%. If 80E deduction is not available, then the foreign remittance, the tax rate is 10% in the no pen, no filer case. These rates are applicable before 1st of July. These rates are also applicable after 1st of July. There is no change by the Finance Act 2023. Pertaining to education, if there is a remittance, Finance Act has not made any change. Remittance for medical treatment, TCS rate is 5%, subject to threshold of rupees 7 lakh. And in no pen, non-filer case, TCS rate is double, 10%. And there is no change by the Finance Act. Even after 1st of July 2023, the same rate will be applicable. The third category is overseas tour package. TCS rate is 20%, no threshold. In non-PAN case, TCS rate will remain 20%. And these new rates are applicable from 1st of July 2023. This is an important change made by the Finance Bill. Prior to 1st of July 2023, this rate was 5% without threshold. In non-PAN case, this rate was 10% without any threshold. One common thing is there: before 1st of July, after 1st of July, there is no threshold limit, but the rate of 5% has become 20%. Any other case of foreign remittance, from 1st of July, the rate is 20%, no threshold. Non-PAN case, the same rate, 20%. This rate is applicable from 1st of July 23. Before 1st of July, the 20% rate was 5% with a threshold of rupees 7 lakh. In non-PAN case, the rate was 10%, subject to a threshold of 7 lakh rupees. These were the changes made in Section 206C by the Finance Act 2023. Another important case changes in Section 206CC and 206CA. Tax rate in the case of non-PAN and non-filer case. Normally it is twice the regular rate or 5%, whichever is higher. But an important change has been made that overall limit will be 20% with effect from 1st of July 23. Either 200% of the regular rate or 5%, whichever is higher. But it cannot exceed 20% with effect from 1st of July 23. Other amendments. There are a few other amendments in TDS and TCS by the Finance Act 2023. In case of Section 192A, if PAN of the employee is not available, then TDS rate will not be the maximum marginal rate, From 1st of April 2023, in non-PAN case under Section 192A, TDS rate is going to be 20%. A new section has been inserted, 194BA, TDS on winnings from online games, with effect from 1st of April 23. TDS rate under this section would be 30%, no threshold. Tax to be deducted at the end of the financial year. But if there is a withdrawal within the financial year, then the income portion after that, out of that withdrawal, would be subject to TDS. TDS under Section 194BA would be applicable whether the winnings are given in cash or in kind or both. Under Section 194N, if the recipient is a cooperative society, then the limit of rupees 1 crore has been increased to rupees 3 crore. This would be applicable from 1st of April 2023. Under Section 196A, TDS rate is 20%, but there was no specific provision that in the case of double taxation agreement, if tax rate is lower, whether TDS would be at the lower rate or not. Now a specific provision has been introduced that if somebody is deducting tax under section 196A, and under the double taxation agreement, the rate on that income is lesser than 20%, then the lesser rate would be applicable. Under section 194B, 194BB, lottery winnings, winnings on games, there is a threshold limit of rupees 10,000. The threshold limit of 10,000 rupees will not be applicable on each transaction, but with effect from 1st of April 23, the threshold limit of 10,000 would be applicable on cumulative basis throughout the financial year. Under section 206AB and 206CA, these two provisions are applicable in the case of non-filer of the income tax return. TDS rate and TCS rate is normally 200%. But there are a few persons who are not otherwise required to submit their return of income. In the case of those persons who are not otherwise required to submit their return of income, a relief has been given by amending the definition of specified persons under these sections. Now onwards, if a person is not otherwise required to submit the return of income under section 139, and if that person is notified by the government, then he will not be subject to the provisions of 206AB or 206CA. There are two requirements. If the concerned person, that is, I mean the deductee or collectee, is otherwise not subject to submission of return of income because of section 139 does not require it. And if that person is notified by the government, if both the things are there, then in the case of such deductee or such collectee, the provisions of section 206AB, 206CA will not be available. There are a few questions in the chat box. Few questions are there from my editorial team. The first question is, leave encashment limit has been increased from rupees 3 lakh to 25 lakh as per the budget speech. It has been activated? No, till date it has not been activated. Government will come out with a notification under section 10, subsection 10AA. And as and when the notification comes, the limit will be increased. Nobody knows whether it will come from a retrospective date or prospective date. It is not part of the finance bill. It is part of the finance minister budget speech. We will have to, therefore, worked out accordingly. There is another member sitting in the audience, a friend of mine, S.B. Rathore. Not a friend of mine as well as my old student of postgraduate class, batch of 1974. He is asking, what is the parallel figure for super senior citizen? You find out the tax liability on rupees 15 lakh for a super senior citizen and deduct 1,50,000 and divide by 0.3. I can calculate it just now. It is 3,33,333. For a super senior citizen, the parallel figure for 375 blocked incentive break-even point is 3,33,333. Another query is from Satish. If a person has only income from interest on FD of rupees 7 lakh, then it is required to pay any tax under the alternative tax regime? No, not at all. GTI limit for filing income tax return under section 139, is it rupees 3 lakh for all alternatives? Yes, subject to conditions, subject to the incentives. Incentives also include exemption under section 54, 54B, C, D, etc. If after disallowing those exemptions, if the amount is 3 lakh or below rupees 3 lakh, then under the alternative tax regime, there is no need to submit the return of income. There is a question from Arun. In case the recipient has not filed the income tax return for the last 2 years, whether TCS is applicable, TCS income tax return and TCS is applicable, what will be the rate? If the recipient has not filed last 2 years income tax return and TCS is applicable, we have to see what is the quantum of TDS and TCS in this case. If it is above 50,000 rupees, then it will be 200% of the normal rate, but subject to maximum of 20%. There are two conditions. Number one, he is non-filer of income tax return for last 1 year or 2 years, as the case may be. And at the same time, the total TDS and TCS in his case is more than rupees 50,000. If both the conditions are satisfied, then the provisions of non-filer of income tax return, double of the tax rate would be applicable, but subject to the limit of 20% in the case of TCS. If payment to outside India is by credit card, 15 CS CV is required. 15 CS CV is required if payment is outside India by credit card. There is no such exemption under 15 CA and CV for this purpose. In the chat box, a few more questions are there. In TCS, there is a question. Suppose advance payment is there before 1st of July. If before 1st of July, TCS is applicable, then the lower rate would be applicable. Certainly, the higher rate will be applicable only from 1st of July, meaning thereby that in the case of advance payment, we will go by the lower rate if it is before 1st of July. What is the time limit for remittance of TDS on rent for individuals? The time limit is the date of payment of the rent for the last month of the financial year, or for the last month at the time of vacating the house, generally in the month of March. Generally taken as month of March at the time of payment of rent for the month of March, TDS could be required for the whole year by an individual. There is one more question from Rathor. Can I claim rebate under section 89 if the ITR is not submitted for the earlier year? Certainly you can take it, because the rebate is available in the current year and you are submitting the return for the current year. Form number 10E also you are submitting for the current year. Regardless of the fact whether return for the earlier year is submitted or not, you can take 89 relief. There is a question from Satish. He wants me to explain the amended provisions of section 195. The rate has been increased from 10 to 20% from 1st of April 2023. As you have mentioned in your question, the rate has been increased from 10 to 20%, applicable from 1st of April 2023 under section 195. Payment to the payments pertaining to the payments under section 115, subsection 1 or 2, If the TT rate is applicable and the TT rate is lesser than 20%, we will go by the lesser rate. If TT rate is higher than 20%, or if there is no TT with the other country, then the higher rate of 20% would be applicable from 1st of April 2023. Any other question? Yes, Samita.
Yes, sir.
Any other question? May I take leave of you?
So we have received one more question in chat box.
TDS by employer not paid. Whether employee can claim deduction. TDS by employer not deposited. Am I correct, Ashok? Employer has deducted TDS, employer has deducted tax. There is a tax deduction by the employer under section 192. But he has made a default. He has not deposited it. And the point before us is, can the employee claim the credit of that tax? First, I am discussing the law, then I will come to the practical aspect. In law, there is no such provision that the benefit of TDS will not be available if the deductor has not deposited it. Regardless of the fact whether deductor has deposited or not deposited, it is the right of the person getting the payment after TDS that he should get the credit of the same at the time of his final assessment. This is the relevant provision of the law. As far as practical aspect is concerned, in such a case, he will not submit, the employer, will not be able to submit form number 24Q. When it is not there in form number 24Q, then it will not reflect in form 26AS of the employee. And once it is not there in form 26AS of the employee, at the time of the assessment, 143(1) intimation, the department will not give the credit, a demand would be raised. Against that demand, he will have to go to the appellate authorities to claim the relief. I think CIT appeals or joint CIT appeals or tribunal will give the relief. But at the stage of 143(1), but at the stage of 143(1) intimation, I don't think you will get the relief. You will have to go in appeal, you will have to fight out the case. Please, there is a question, name is not available of the person asking the question. Please clarify whether TDS on software payments. TDS on software payment is royalty, and the rate of royalty would be applicable. Whether any PDF will be available, certainly you will get the PDF copy of this. If still you have one or two questions, you can ask me. May I take leave of you? Thank you very much. This is my mail ID. Whenever you want to discuss anything pertaining to this conference, you can write a mail to me at this address. Thank you very much.